Well, no, I'm interested in hearing now.
Well, the deal is, folks, is that futures involve leverage. So you can trade $100,000 bond contract, a T bond contract, a 30-year bond contract for several $1,000s. You can trade $100,000 of silver for $9,000 margin. And because of the leverage involved, the options in futures contracts pay way, way, way more than what you folks are seeing in trading security options.
But
So,
what if they go the other direction?
well,
You
the
have a physical
options
position,
can't
and
go the other direction. If you have a covered call, you're guaranteed the money from the call. If the
but
futures
how
go
much does the
down,
call cost?
that can happen. But I think bonds are close enough to their lows.
Okay, but do you have to pay short-term capital gain on the covered call profit?
Here's how futures work, folks, for everybody in the room. No matter if you are in a trade for 5 minutes or 5 days or 5 months or for a year, although the kind of trades I'm talking about are like 30 to 50-day trades. Okay. Futures are taxed 60% capital gains, 40% ordinary income, unless it's in a retirement account. If it's in a retirement account, then there's no tax on it, depending on when you take it out or if it's a Roth contract. But futures across the board, it doesn't matter if you're in it for 5 minutes, if you're a short term scalper, or 5 days, if you're a swing trader, or if you're a position trader for a year. It's 60% capital gains, 40% ordinary income.
Who's the other side of your silver covered call then?
You don't know who it is. It's
No,
a
is it
it's a
is it
two-tier
a
trade.
corporation, or I
Well,
mean,
it doesn't.
theoretically?
In the futures contract, it's another trader. It's somebody. You buy the futures contract, so you buy the T bond contract from a seller, or you enter a buy order, and somebody on the other side that thinks that they're hedging their interest rate risk or something, so they're selling. So you got a counterparty for the futures, and then you sell the out of the money call to some speculator that thinks he's going to have a profit if the futures go higher. But the way I do it, for example, I'll give you a quick example. Futures, let's say silver futures are $20. They're under $20 right now. But if you buy let's say the March now, because December will be December contract will be going. The options expire about the 23rd of this month, so it's only a 22-day trade. But let's say if you buy the March futures at $20 and you sell the $24 call, so $4 out of the money, you'll probably get a call sold for 50 cents. Well, 50 cents is $50 bills, $2,500. Well, $2,500 on a $9,000 margin is 35% return from selling the call. And this is a 3-month trade, folks. 90 days, 90 or 95 days. So if the futures go up, remember I told you it's $9,300 margin. For every $2 that silver goes up, silver, the last trade on it tonight is 1968. That's the December contract. The March contract is under $20. All right.
And what's your cost on the margin?
$9,250.
No,
Okay.
but what's the
If
actual
if silver
what's the
goes up,
rate?
if silver goes up $1, it's $5,000 per dollar. So if silver goes up $2, you double your money,
And if
100% return on the margin. Plus, you're going to get the 40 cents from the call option that you sold. That's another $2,000.
okay, and
Okay.
if it goes down $2, what's the math?
If it goes down $2, you lose that same $10,000, but you sold the call for 40 cents. All right.
And
So
you
it's
recover half.
60
Yeah.
net. And after pretty much from the price level we're at, if you don't make money on the first option cycle, you'll be whole and profitable by the second or third margin cycle, where that we've taken that much risk out of silver. And the same with the T bonds. Now T bonds, they bottomed out at like 2.5%, and now they're like the 30-year yield is like 3.9, something like that. So the price of the bond has fallen from like 160. That's the price that was when we were at the lows on the 30-year bond. Now they're down to like 120. So they've lost 40 points. They've lost $40,000. And that's where I was trying to, talk with Bobby a little bit, that if you have a long-term bond and the yield starts going up, it went up from, 2.75 to 4, you have a capital loss.
That's also true. Yeah.
Covered
because
calls,
the actual price of the price of the bond goes down. I mean, it's a perfect market.
covered calls,
in that.
covered calls are a great way to trade because they'll help hedge the risk in the futures contract. The one bad thing about a covered call is it does limit your risk. I'm sorry, limit your reward to the strike price that you sold the call at.